Russia talking to their on-again, off-again friend Saudi Arabia about cutting production. All that and more on this Energy and Materials edition of Industry Focus. Greetings, fools. Sean O'Reilly joining you here from Fool headquarters in Alexandria, Virginia. It is Thursday, January 28th, 2016, and joining me to talk shop is Tyler Crow and Taylor Muckerman. How's everybody doing?
Hello, hello.
Wonderful. Everybody enjoy their blizzard experience this past weekend?
Most snow I've seen in my entire life in 24 hours.
Well, yeah. Did you go skiing? No.
No, I did not. I'm going a couple times this year, but unfortunately not this past weekend.
Everybody watch Netflix?
I actually left town before.
You did not. Where'd you go?
No, I actually went up to the mountain so I could ski all weekend. And got me out of town, and I showed up on Sunday evening and had to shovel out my driveway.
My next door neighbor, I know the building put like little snow notices, like safety, whatever protocols in the door knocker, and theirs still isn't down. So they left town and they're not back yet. And I'm kind of like, it's clear now, guys. It's safe to come back. Like,
so that was the most surprising thing. Like, I grew up in New England. I'm kind of used to snow. The one thing that I didn't really realize till I got down here, there's no place to put it in DC.
Dump it in the Potomac. Like, that's all we got.
Like all the neighborhoods, there's no place to put the snow. So if you get any, what the heck are you going to do with it?
The planning was bad with the whole. So really quick before we get started here with a bit of earnings news, did you guys see the news this morning that Saudi Arabia publicly just flirted with the idea of maybe talking to OPEC, and of course it sent oil up a bunch and all this stuff?
Yeah, well, that happens.
Do you think Putin's running out of money? Yeah, oil's up like 5%.
Oh, all
a
right.
little way to go. Yeah, all right.
Shows you how much we really pay attention to the daily movements of oil.
As long-term foolish investors, we're not supposed to pay attention to daily moves, but it was just funny that Saudi Arabia was kind of flirting with their on-again, off-again friend, Saudi Arabia. But anyway, so we've gotten a decent number of earnings reports out for the energy and industrial sector, and I wanted to obviously just dive in and see if any stood out to anybody. So Taylor, anybody sticking out to you so far?
Well, yeah, Core Labs is a company I own, so I pay attention to it whenever they report. Not just because I own it, but because they typically have a pretty good understanding of what's going on in the oil and natural gas markets.
They're basically, for our listeners that don't know, the world's favorite oil consultant.
Yeah, they use data, technology, science, chemistry, all these different mechanisms to determine the best way to produce oil or natural gas from individual wells across the world. Not only originally produced, but also production enhancement is a big part of their business, and that's the part of the business that suffered the most in this last quarter. You look at total revenue down 7.5%, but enhanced revenue enhanced production segments revenue down 13%. So almost double.
It doesn't sound that bad. I mean, correct me.
But that's also going up against a relatively tough comp in 2014. So we're done with the hard 2013 comps where oil prices were soaring. We're starting to see comps against a rough 2014.
And that's why it doesn't seem like only 13%.
Yeah, because they were flat essentially in the third quarter of 2015, down 7.5%. So quarter after quarter, they are down. And so it's a little tougher for them. And the production enhancement segment deals mainly with shale and offshore. So we're talking about some of the more expensive oil to produce at the moment. Obviously, those are two segments that are going to see some decline if oil prices remain at $30 a barrel.
Now, Core Lab's CEO has been one of the more bullish CEOs, and he just talks about decline rates all day long and everything. Did you catch anything new from him at all?
Not necessarily on decline rates, but he did say that he expects a V-shaped recovery to begin in the back half of this year. So look for maybe late third quarter, early fourth quarter in his mind to see some recovery, and not just a slow U-shaped recovery. I mean, they either go V or U in the oil markets, is all people ever refer to. So he's looking for a relatively sharp recovery.
There's nothing in between. It's either a V or a U recovery.
Yeah.
You can't have anything.
It's all black and white.
No W, no Y, no X, just V.
No J's, none of that.
No. So he's expecting a sharp recovery relative to what other people are expecting, including Schlumberger, who Tyler, I think, is going to chat about a little bit.
You spoiled it. What the heck, man? No, I'm just kidding.
So
all right, so Tyler, what do you have to say about Schlumberger?
Schlumberger
passing the buck here.
Probably, if we want to call Core Labs the optimist, I guess Schlumberger was a little bit more of the pessimist. On the earnings basis, kind of the same thing. Some low hurdles to jump over, or actually not jump over. Their fourth quarter revenue was down about 9% compared to actually last quarter. And margins, our pre-tax margins, are down to about 16%, which doesn't sound great considering, over a year ago they were in the high 20s.
So they're having to are they having to cut the same prices, or why is that?
There's a little bit of a lot of it has to do with activity decline in certain sense, where if you look in like the land rig market in the United States, there's only about 680, 690 rigs compared to 1,600 that we had more than
a year ago,
18 months ago.
Yeah.
And so you have that of just idled and lack of sales, but you're also seeing one of the things that CEO Powell Kipsgard actually did mention was that they're seeing lower prices on contracts. Certainly ExxonMobil and Chevron have mentioned this, where they're getting about 15 to 25% savings on their service contracts in terms of like their day rates and things like that. So that's where you're starting to see a lot of the declines in margins and in sales. And, on that 16%, it doesn't sound great coming down from the high 20s. But, I mean, putting it in a little bit of perspective, if you compare them to Halliburton, Baker Hughes, Weatherford International, they still have at least 7 to 8 percentage points higher on their pre-tax margins. So, they're having a good time in comparison to the rest. It's not great, but, And then on their outlook, a little bit of echoes of Core. I mean, not as optimistic. They were saying that in 2016, in the second half, we'll start to see that recovery in oil prices, but they're actually saying that it won't lead to increased drilling and service activity.
There's going to be some conservatism
until 2017, right? And one of the biggest reasons was the fact that a lot of these producers just have obliterated balance sheets, and they've got to throw some cash back at the business itself before they're ready to take on anything new.
Well, plus it's like, we're at $30 right now, and even if it went back to 60, there'd be some kind of like, okay, is this for real? Because we got flirted with last spring. And
well, yeah, last spring we went to 60, and everybody, not everybody, but there was a small handful of companies that wanted to kind of open the pipes up again. I know Pioneer Natural Resources was one of them,
right?
And that just kind of backfired on them.
Yeah. So cool. Does anybody know who I picked?
Oh yeah,
we didn't segue into yours, but Sean, tell.
Please. I was curious what Caterpillar had to say. They are stuck in the midst of a 3-year bear market for commodities, and up until 18 months ago, oil and energy was the last holdout for their machinery and everything, and that's just not, it hasn't panned out either. So they actually reported this morning, and the earnings were actually pretty good. They beat a little bit, but obviously revenues and everything were down. Revenues came in at $11 billion, down from $14.2 billion in Q4 2014. They reported a loss of 15 cents per share, but they would have reported GAAP profits of 74 cents had they not taken like a $900 million hit from restructuring costs. So, I mean, investors really should keep that into account, because any large organization like that, they're going to have restructuring stuff all the time. Like, you shouldn't really take any credence to that 74 cents per share number. But anyway, management talked exclusively about how tough it is out there, and they just went on and on about how they're cutting costs. That's literally like half their call, half their press release, everything.
Yeah, Schlumberger laid off a lot of people, but Caterpillar's been laying off people for a couple of years now.
It's getting hairy, yeah. And of course, I was really interested in what they thought about their 2016 outlook. They do not anticipate any bounce back in any. I mean, they're obviously not just in oil machinery. They do copper, all the mining machinery and everything, and they are not expecting an improving demand picture at all for their equipment. They call for sales and revenues around $42 billion, and GAAP earnings per share, I was happy to see this, of $3.50 per share. So
not the worst in the world. Bad. I mean, what was it this year? I think total year was somewhere in 4 and change.
Yeah,
so
4 and change. So
it's not the worst in the world. So obviously Caterpillar is a cyclical business, just like everything else here, and we'll probably see a little bit of a lag on pickup on equipment, similar to like we were talking about with drilling activity, where they're probably not going to be buying any new equipment until prices going up.
Got to pay your bondholders back first.
pay the debt and stuff like that. But at today's prices, if we're looking at, as a long-term investor, is their value kind of baked into shares nowadays, or do you think maybe maybe hold off?
And that's when
bit?
I went into this, because I'm like, we're at the bottom of the cycle. Things are getting really bad. Maybe it's a buy now. They're trading at $59 and change this morning. It's up like 1.5% on earnings. It's down from I think 110 a year ago or something. It's 52-week highs, well over 100. But you heard me say the guidance for 2016, which is $3.50 a share. So they're trading at 16 times forward earnings. I think that is more than fair, given we don't know when things are going to rebound. We don't know when earnings are going to rebound. The market multiple is 19 or 20 right now, so I think it's fairly valued.
Fair enough.
So, all right, moving on.
Sean's first foray into deep analysis on the show.
I'm calling. Hey now,
we should get we should get some feedback on emails. How did Sean do?
I think
Save that for the Major League Baseball draft.
Yeah, right.
Fantasy
what are we calling
baseball
that, by the way?
draft.
Oh yeah. Anyway. Next story, Royal Dutch Shell and BG Group, their deal got finalized, but the real question is now what? 80% of shareholders approved the merger, thinking that management would be able to make something of it. Obviously, things have not been going well in the oil and natural gas markets, BG being a natural gas player. Is it too early to call this a failure, or did shareholders really truly get burned for their trust in Royal Dutch Shell's management? Taylor, what do you think?
Too soon.
Too soon?
Yeah. I mean, they're not expected to double their LNG production for a couple more years through this deal. Let's give them at least a little bit of time to be one company. You know, they're not together yet. They're still in the approval process, so let's give them time before they don't shoot themselves in the foot, or they do shoot themselves in the foot. Right now, they haven't done anything other than make an offer and try to solidify it, right? So.
And everything's 2020 in hindsight. Do you think, given what we know now, natural gas is at $2, all this stuff, do you think maybe they should not have done it? Given what we know now.
I guess you can compare Exxon when they purchased, what was it, XTO?
XTO Energy, back in 2010.
And then natural gas prices fell off a cliff.
Yeah.
So you're kind of, granted, they didn't buy it in the middle of the downturn, or at least Shell thought they were buying maybe in the downturn at the bottom. Turns out it wasn't the bottom. But I could only see upward movement from here over the
Fingers crossed,
yeah. Fingers crossed, exactly.
Cool.
I think the LNG scenario for them will be pretty robust. I mean, there's calls for over the next 2 or 3 years that it won't be that great. But, let's look beyond that, because like you were saying, a lot of their ramp up is going to be a few years down the road. So on that end, I think they're actually going to be pretty good. But offsetting that, one thing that worries me a little bit is going to be when you combine these two companies, they have a very high exposure to deep water production, especially in places like Brazil.
Which is long tail, high cost.
Exactly. And that's one of the things that certainly, I'm not going to say that we're going to stay in this low price oil environment for a long time. I think in the next couple of years or so, we are going to see some sort of recovery, because right now it's pretty unsustainable in terms of development and anybody actually making any money. So, but beyond that, these high costs of places like Brazil, Shell already nixed its Arctic exploration programs. Being tied so heavily to the deep water production is going to make me a little bit nervous when we have shorter cycle, cheaper options like shale oil, shale gas that are starting to emerge. That, maybe that's not that deep water isn't going to be as attractive as it looks today. That's my only concern.
Cool. Well, before we move on to our mailbag question, I wanted to point our listeners to focus.fool.com, where they can take advantage of a discount on the Motley Fool Stock Advisor newsletter that works out to $129 for a full 2-year subscription. Once again, that is focus.fool.com. And our mailbag question of the day comes from Joseph Crivelli, who writes to Sean, Tyler, and Taylor. I have say that 5 times fast. I have an oil question. Given that the U.S. has advantages you've all discussed in the past regarding our possession of advanced oil refineries and high-quality oil in the ground, I wonder if you might add some color to the nation's relative strength in one or other end markets for oil-based products. What does the U.S. pie look like sliced up into for various other oil product families? Do non-fuel uses of oil color our domestic and new export market potential? We tend to reflexively think fuel products are the most important drivers of the domestic oil product, but plastics and other products may be even more important for faster-growing domestic oil uses. How important are these other uses for crude? Yours foolishly, JC.
Can you repeat the question?
Yeah, I can't now. Honestly, you know what? I'm going to just boil it down for you. It's kind of like that scene in The Graduate when Dustin Hoffman gets told that he should get into plastics.
Fair
Is
enough.
that the future? Is that a big deal?
It's still going on. So it's been a good run for Dustin Hoffman if he did get into that market. I don't know what his future held after
that happened
the movie,
in,
but,
didn't George Bailey's friend get into plastics for World War II or whatever, and It's a Wonderful Life? Like, George, put all your money in.
You're really throwing it back to something.
I like good old movies. I'm sorry. These are two American classics.
I watched
I
The
apologize
Graduate
for nothing.
over New Year's on my flight back from Portugal.
And you probably saw It's a Wonderful Life at Christmas.
No, I did not see
you didn't?
that. No,
Why do you hate America?
Only The Graduate.
Why do you hate America?
Yeah, plastics. So in the international scheme of things, oil does impact plastics because you can get ethylene from, or naphtha, I guess, turns into ethylene somehow in the whole formulation. But in America, we're producing
with alchemy.
Ethylene at near record rates for us, thanks to natural gas booming. So 2014, you saw the U.S. have a tremendous advantage when oil was over $100 a barrel. So on a global platform, we're not quite as competitive anymore because oil prices are in the $30 a barrel range. So naphtha is now cheaper to produce in parity with ethylene here. But long term, we have this natural gas supply that we could use for decades. So you see companies like Dow Chemical pouring billions of dollars into facilities down in the Gulf region to take advantage of this. And I think that that's going to probably continue. The money right now is being spent, so these plants aren't necessarily coming online, but we're producing, it's over 1 million, what was it? I had it right here. Record levels of ethylene in America. The aggregate number doesn't necessarily matter. It's at a record. So I think that long term that's going to be a competitive advantage. Right now, oil prices came back, so it's not necessarily, but this is a long term thing.
Right. Tyler, you're saying something interesting upstairs when we were talking about the show.
Well, it's kind of on the same idea as the fact that with such cheap natural gas, I mean, even at 30, surprisingly,
wasn't it 13 like 5 years ago?
13 what?
$13 per BTU for natural gas. Like at the peak in 2008 or something.
That was quite a while ago before the shale boom took off. But what really Taylor is getting at is kind of like that oil and gas spread price, and I believe that at right around 8 to 9 times the price of gas. So if you multiply price of gas by 8 to 9 times. That's about the equivalent when you're looking for naphtha and ethylene production. So even at today, there's a slight margin. It's not certainly as great as it used to be, like you said, at 100. But kind of going back to Joseph's question, do we have any opportunities of using oil in that regard? And if you look at the way that oil is used in the United States and almost everywhere else, the portion of pie of oil that is used outside of transportation is rather small. More than 70% of all oil goes into
petroleum.
It goes into transportation. Yeah. So if you're looking to make a play, I guess you could say, in the non-transportation aspect of oil, it's a very, very hard niche to invest in.
I mean, just buy Dow Chemical at that point, right?
But
they're actually trying to
but they're moving to natural gas
Yeah,
anyways.
so-
I mean, if you look at all of these companies, and if you want to really think about how to get into that realm of plastics or the non-transportation aspect of petroleum and hydrocarbons, look at the investments right now. The investments are all in natural gas in the United States as a feedstock. And if that's the way you want to make a play on it.
We're the Saudi Arabia of natural gas, haven't you?
Well, yeah,
heard?
Dow's trying to make from 70% of their ethylene coming from the U.S. to about 80 to 85% of it coming from the U.S. over the next few years.
Yeah, CP Chem, which is a joint venture between Phillips 66 and Chevron, multi-billion-dollar ethylene facilities down on the Gulf Coast. ExxonMobil's looking to more than double their production down there. Yeah. I mean, there's companies left and right going down to the Gulf and just setting up shop with these massive chemical manufacturing facilities.
Cool. Okay. All right, so we're going to do a little round robin question for everybody. What storylines are you following in the most recent earnings season that is now well underway? Who goes first? Anyone?
I'll go first.
Draw straws. Okay.
I follow big oil a lot, so obviously I'm
ExxonMobil.
I'm definitely going to be watching how the big oil players do this quarter and how they start looking at 2016. Typically, we don't start to see their analyst day presentations where they release their budgets until March. So maybe not.
This is when they go to New York and do their little dance.
So that's when we'll start to see what's going to happen in the coming year. But sometimes you get a little bit of hint of what's going on on their conference calls in the coming one. But at prices today, we've seen companies, Shell, ExxonMobil, Chevron, they've really been struggling. at meeting their capital obligations, Chevron especially, because they're spending so much on those large projects like Gorgon and Wheatstone. Are they going to be able to maintain it all the way through 2016 without significant deterioration of their balance sheets?
Cool. Taylor?
You want me to go? I'm just kidding. Just continue to watch margins. We got to continue to wait and see some normalization at the very least. I don't expect any expansion, but maybe the reduction in margin starts to slow down. And then also, who cuts their dividend this quarter?
Somebody's
cutting their dividend this quarter. I just don't
make that?
know.
How about we make that a game? Let's make that a game.
We're going to do that next week.
No, hold on. We're going to make that a game for our listeners.
Okay.
So email us,
or
tweet at us.
Or tweet at us. It doesn't matter. Find us somewhere.
Yeah.
And email us. Tell us what company you think is going to win or is going to cut their dividend this quarter. We got some Motley Fool
You will
swag
get, at the very least, a shout out on the show by name. It'll be awesome.
The very least.
Yeah. Well, I don't know. We can't guarantee swag without clearing it. I don't know.
We can give a hat out.
Fine. We'll give a hat out. I'm particularly interested to see companies have been cutting a lot of capex, as we are all fully aware, like hundreds of billions of dollars. However, this came along with some impressive efficiency gains last year, which pretty much kept production. I mean, the U.S. lost 500,000 barrels a day, but we're still over 9 million at last count. So we're starting to see 2016 budgets come out, as Tyler mentioned. So I'm expecting deeper cuts, but I'm extremely curious to see where companies think their production is going to be for this year. This question came to mind for me because Continental, led by the one and only Harold Hamm, came out and said they're cutting capex again this year by like 2/3 or something.
60-something%.
Yeah, 60. It's crazy, but they actually think that their production's only going to drop something like 10%, and they think their natural gas production is actually going to go up. And I was like, whoa. So I don't know if
that's
they're
just
an
because they're
outlier.
going to capture more of their flared natural gas.
Yeah, whatever. Anyway.
I'm slightly apprehensive.
You think they're an outlier?
It's not that I distrust anything that he says, but this is also a guy that back in 2014 when oil started to decline, completely wiped out all of the hedges on his company to protect cash flow, saying this is unsustainable. Well, now we're 18 months later, and it's still going on.
And it's lower.
It was a wrong bet. So I'd like to see him make some right bets before I really start to trust what's going on with him.
Cool. All right. Well, that is it for us, folks. If you're a loyal listener and have questions or comments, we would love to hear from you. Just email us at industryfocus@fool.com. Again, that's industryfocus@fool.com. As always, people in this program may have interests in the stocks that they talk about, and the Motley Fool may have formal recommendations for or against those stocks, so don't buy or sell anything based solely on what you hear on this program. For Tyler Crow and Taylor Muckerman, I am Sean O'Reilly. Thanks for listening, and Fool on.